Good morning, it's Jeffrey Cohen. It's July 8th, pre-market. It's going to be a great day today. And so let's talk about the markets. Let's talk about our model. We made a pretty big change yesterday. We were kind of fooling around with the code and trying to make it better. And I think actually we made it worse. And that's okay. So today we're going to fix it and make it better again. But I will share the types of stocks that I picked because it was a little bit different today. And we made some changes to the risk-free rate of return. And I actually have my first actual recommendation to make on July 8. Chicago Quantum, which is the brand name of US Advanced Computing Infrastructures, Inc., has a financial recommendation for those who can invest up to $10,000 for up to 5 years. U.S. savings bonds, the I bonds, are right now paying 9.62% for the first 6 months that you hold those bonds. And as long as inflation stays up, the government pays a small real rate of interest. And so nominally, you can earn 8, 9, 10% interest. That's great. That's not normal in our market today. And so I recommend for those who are U.S. citizens, you're allowed to invest up to $10,000. I mean, you're guaranteed to earn the money that they tell you you're going to earn because it's the U.S. government and it's considered very much a risk-free rate of return. So I find this fascinating because that's a lot of money. So point one, U.S. savings bonds, I bonds. If you got up to 10 grand, drop it in, forget about it. By the way, if you use the money that you earn with savings bonds to pay for either your education or your kids' education, let's say college, the interest is tax-free. That's even better. So if you're earning 9.62% tax-free, wow. I did that a long time ago when I went for my PhD. No, I didn't actually need my bonds for the PhD, but I needed them for the master's degree. I sold some bonds, and I was so happy because I didn't pay any tax on it. I'd had those bonds for like 15 years, and so when you sell them, they have a lot of income, and so it's great. All right, so that's one. Second thing is we updated our model yesterday. And a couple things happen. I'm not exactly sure what's going on in the market. So I see things and I'm pulling them together. And I got to tell you, it seems a little weird. So the second thing I notice is, the Russell's still down over the past year dramatically. The QQQ is still down dramatically. The SPDR's down, which is the S&P 500 Index ETF, or tracking fund, which you can buy and sell at any time on the stock market. Paid a 1.3% dividend. It's minus 9.3%. So you've lost 8% in the S&P 500. But really, the S&P 500 has recovered a lot. And I was reflecting on this yesterday. So if you look for a month, sure, it fell a lot. This is the Russell 2000 E-mini futures, right? So it fell. Of course it did. But it has climbed, it's fallen, it's climbing, and it's trying. These are indices. I'm just looking over the past month. Down and up, trending higher. And so I think we can still believe it's a bear market. Right? You see the trend over 6 months is still negative. And I do believe we're still in a bear market. I do. But I think that there's a little bear market rally going on. And I think it's easy to get sucked in and to believe that there's going to be a rally. Could be 10%. The market could go up 10% during a bear market rally, but the bear market could be a drop of 40%. And so you still have to be ready, and you still have to kind of deal with the emotions of watching maybe bets against the market, or maybe you're just a normal person and you took your money out and you're just sitting out. it's in cash, it's in some bonds, some low duration bonds, money market, or it's in a bank account. And you're like, you know what? I'd rather have the money in a bank account than to lose it in the stock market. And so I know it's difficult to watch, especially like if the Russell. Here we go. Pull the Russell up. Russell's like risky stuff. The Russell. It's very risky. It's small cap stocks, right? These are this is Main Street America, right? And so you look over 2 years and you're like, oh, huge climb, really fast climb on the Russell. Like how long did it take? It was at the low in September 2020. And by February, it had reached its high. So September, 5 months. And then it's been flat for a really long time. Like it was flat February to January. 11 months of flat. And so you're probably thinking, all right, it's fine. I didn't lose any money. Right? I'm good. And now it's down. And one of the things we look at when a market drops is we look at the lows that it made. So here it made a low, a closing low. And in fact, I might need a different bar. Yeah, there you go. So the part that goes in is when it opens. The part that it goes out is when it closes. So you want to look for the lowest close in an area, right? And then we're going to draw a line. And this is like the crappiest chart I've drawn in a long time, but we're going to try it for you, right? You see I already have another line in there, right? Clear drawings. Let's do a nice fat line for you. So it closed here, and then here, and then here. And it looks like, nope, there's your lowest low in that section. There's a low. So that's a pretty steep decline. So maybe that's not it, Jeffrey. That's too steep for me. That's a crazy line. That says that the market's going to zero, right? So let's not do that. Jeffrey, you're a crazy man. So let's fix it. Let's take out the volume because we're just not going to look for now. We're going to see the volume. So that's not so bad, but it shows you there's more room to fall, right? So let's look at the second one. So from this decline to this decline. Now that looks a little better, right? And you can see how it's trying. It's trying to come there, but it didn't. It went the other way. It went up. So there's your trend line, right? And so if it maintains along the trend, you should be around 1650 right now. So who knows, right? But the trend is negative. My guess is if you drew the same thing for the NASDAQ and the S&P. So the reason I like the S&P is it's a really, really super efficient investment. The S&P 500 is one of your most efficient investment vehicles like ever. Like it shows up doing really well on the runs. It is a very good risk return profile. So here you see how it go back a little bit. So it went up, fine. So right there was the peak. It peaked December 26. God, we rode that curve down before we realized it was going down. Boy, are we sad. So there's a low, and there's a low. And that's a pretty good line, actually. And then there's a low. And there's a low. And that's a crazy steep line. And then it looks like it's coming up. Right? And so it's hard to know. Is it going up? Is it going down? Do you know? Do you care? Right? So what's going on? So we're going to take a look at the markets. We're going to see where we're at. And so I guess I'd like to say something. There was some very sad news last night. Shinzo Abe died. Shinzo Abe was killed by a Japanese veteran. He was one of the most successful, important, committed politicians in Japan was able to get along very well with many U.S. presidents, brought Japan out of what I would say more of a pacifist stance into a very much a more powerful stance for Japan. He also had an economic policy of basically hitting zero interest rates. Drive interest rates to zero, people will make investments. And so I'm so sorry. I'm sorry to the people of Japan. It actually cost me about a half hour this morning thinking about it. So I didn't realize Japan had a gun problem. You know, too many guns on the streets. See, I went to Japan. I never saw a gun. People are nice. They live in close quarters. They're polite to each other. I didn't know they were running around with custom handguns. It looked like a sawed-off shotgun and shooting near politicians. I mean, this guy was loved by so many. A unifier like no other. It's awful. So I want to say my condolences to the Japanese people. I'm very sorry. And this is on the heels of just a few days ago, our hometown had the most violence that it had ever had. Highland Park, Illinois, had a major shooting. A kid, 23 maybe, normal kid, went to Highland Park High School. I mean, sure, liberal upbringing. Parents got divorced. Dad owned a grocery store. I don't know what the mom did. Seemed like nice people, right? They weren't weird people. They lived in Highland Park. They were members of the community. I don't know. And then I guess he broke up with his girlfriend. He felt a lot of pain and anguish, turned to drugs, turned to alcohol. By the way, I don't believe in drugs being legal. I think that drugs are bad and they should be tightly controlled. And so when you get hooked on drugs, all of a sudden maybe weird things happen. And so we had our own big shooting. And so then I see this, and Abe being shot. It's mind-blowing to me. Japan is one of the safest places I've ever worked. And the nicest, kindest people that I've ever met. Yeah. Heart goes out to you, man. Look at that guy fighting for Japan. I love it. Fighting for Japan. Fighting for peace. Love that guy. All right. Well, moment of silence there. I just wanted to let you know how I was feeling about it. So what are the big things to watch today? Interest rates are going to be a big thing to watch today. So rates are down a little, right? So when the rate goes down, the price goes up. And when the price goes up, it means people pay more for the bonds. It means the bonds, in theory, are going to have more return. Less return. Price going up. That means banks, insurance companies, those who invest in bonds are going to do great. So when the 30-year Treasury rate climbs to 3.2, we think, bonds are cheaper, right? You go out and buy one. Remember I talked about savings bonds, right? Bonds are cheaper. Can you imagine if this bond was paying 9.62%? Wow. That'd be crazy, right? You can get it as an American citizen if you're an American citizen. Think about your iSavings bonds. Look at the 1-month Treasury bill. 1.5% basically. So that's important to talk about. Because when you look at the 1-month Treasury, that rate was under 1% 2 weeks ago. So we did something in our model and it had a really ugly effect. So I'm going to leave that up there for you because maybe we didn't move fast enough. So the S&P 500 variance. So this is the run through July 7. Ugh. My God, Jim. Ugh. Wearing a Bears hat because we're in a bear market. It's a bear market rally. I just want you to remember that. Bear market rally. Red shirt. So, the S&P 500 variance. 1.58 times 10 to the negative 4. It ticked up ticked up yesterday, but not today. The HVAC kicked on. I'm so sorry. Hang on. It gets loud. I'm going to check on the cat. What are you doing, buddy? Oh, let me see something. Now that would be a good video. My cat is slinking in the backyard. I see something, right? So, we took the risk-free rate of return up to 2%. Therefore, the market return, because the markets have been dropping, it's down to 3%. So who wants to earn 3% nominal rate on their investments? I don't. 3% is garbage. So throw it away. And so, first off, the stocks that it picked with a tiny edge, tiny edge. It's the smallest edge I've ever seen in the model. It has a lot of losers in it. Apple, APAM, BX, Into, Microsoft, NVIDIA. Some of them I don't know, VMware. So the model has just big tech names and big financial service, or medium-sized to big financial services, tech. I don't even know who CHRD is. Let's take a look. Who is CHRD? Cord Energy Corp. Yeah, never heard of them. I'm not going to say anything bad about them, but A-Mark Precious Metals. I haven't seen them show up in a long time. PCH. Isn't that Pacific Coast Highway? I used to wear those shirts with PCH on them. Potlatch Deltic Corp. RMR. What the hell did the model do? The RMR Group. Shen. Shenandoah Telecom. The model's picking the weirdest stocks. And so here's the deal. If you want to outperform the S&P 500, you got to hold some pretty interesting esoteric risks there. Shenandoah Telecommunications, along with Apple Computer, along with VMware. That's a weird risk profile, just so you know. And then maybe that's what you need. But that would outperform the S&P 500. Okay. Top stocks. My cat's meowing. What's going on in this house? Crazy house right now. Berkshire Hathaway is your fourth best stock. Berkshire Hathaway has an expected return of 4%. Volume is down slightly, down 14%, 13.5%. Trades at a 7% discount over the average of last year. No dividend. Big market cap. Good cash flow from operations, but look at that AOCI. So it's always a question, right? You can't see AOCI on the income statement. You have to look carefully. So $616 billion for Berkshire Hathaway. Cash flow is only $37 billion. By the way, that's a lot of money. $37 billion, right? Long-term debt's $120 billion. Net income is $84 billion. So that's interesting. They make 84.5, but they only generate cash of 36. Negative AOCI is about 4.4. So they give 4.4 of the 84 back off the balance, basically off the income statement. You see McDonald's. But like well built. What's going on with well built? WBT. I had so many things I wanted to show you this morning. To be honest, I got very distracted by the Japanese ex-prime minister being killed. I was really upset by that. So well built. I don't know what the hell's going on here. It's pretty flat. It's pretty boring with the drop. I guess if you would have bought then, you would have made a ton of money. You would have made 85 cents. I don't know what's going on there. Look at that. It's flat as a pancake. So well built is a safe bet. That's what the model wants you to pick. Safe bets. Safe bets. 2.3% expected return. PNM, 2.5% expected return. Crestwood, 2.7%. Safe bets. The market, because buying risk right now just doesn't give you the same type of juice, of excitement that you had before. When the market rate of return is 3%, risk is expensive. Risk is very expensive to have in your portfolio. That's why people sell stocks in a down market. Because in this case, when interest rates climb, it's very expensive to hold stocks. The risk just isn't worth it. The other thing that was interesting, well, first off, we communicate a lot with our data provider, and we let them know about some stocks that are odd. But these are stocks that are now showing up in our model. And we're constantly removing stocks that are not listed in the U.S. So Canada, Bermuda, Canada, Luxembourg, China. And we're getting some interesting new stocks showing up. And I don't know if these are just newly listed stocks on U.S. exchanges or what's going on, or it's just that they're catching up. And so, because I knew like NV was going to be in Netherlands, but this was listed in the U.S. and I let them know that this was probably a problem, and so they have they fixed it. Like here's another one, NXP Semiconductor, NV, doesn't have a country. Of course, it should have a country. So when we look at the up run hasn't. Whoa, that's high, man. That's high. Okay, we got to talk about something. The expected return of holding. This is important. I'm going to talk you through this. This is like technical mumbo jumbo. This is inside baseball. Let's do a little inside baseball here. Even though I'm wearing a football hat. The Chicago quantum net score, when we true it up, it is set to 0 at minus 8.1 times 10 to the negative ninth. So that's pretty accurate. That's a pretty true 0. The expected return if you held all of these stocks. How many stocks, Jeffrey? How many stocks? 2016 stocks. Okay? So if you held all 2016 stocks evenly, you'd earn 5%. Now that's a lot more than a 3% market return. So why is that? It's because your all stock variance just went up to 1.9 times 10 to the negative 4. If we take a look at the research we've been doing on volatility, if you go to the website, chicagoquantum.com, I know most people don't want to look at this stuff. It's weird. Weird math. Nobody likes weird math. It's under the research tab. Who's looking to research for some rinky-dink investment advisor representative who's opining on market data? So we're going to look at daily price variance. I updated it yesterday, July 6th. I try to keep this stuff current. It's hard to do that, right? So when we look at at the time when we started, there were 2,160 stocks with a profit. So, oh, by the way, yesterday we took out the cash flow requirement. And so you got slightly more stocks, but not many. You saw that 2016 stocks. It was 2013 stocks. So the cash flow, so companies that made a profit but didn't make a cash flow, there were only 3 of them. Only 3 stocks in our model from July 6 to July 7 made a positive net income but negative cash flow from operations. It's fine to leave the 3 in. The bigger point is, look at that variance. It went from 1.6 to 1.9. Higher variance. So what did we see in the market? We see significantly higher variance on stocks of profitable companies. So you have to understand what that means. It doesn't mean that the market's going to go down right away. It doesn't mean it's going to go up right away. It doesn't mean you're in a bear market rally. What it means is that all things being equal, even the good stocks are more risky. There's more risk. How'd the down run look? So I did not update the risk-free return on the down run. We did all of our experimentation on the up run. Had it have backfired or looked bad, we would have gone back to a previous version. So let's take a look. So there's 1,513 stocks, and that risk rate, or that variance, is 4.9. Really a little change. It went from 4.8 to 4.9, so it's up a tick. So risk is up. Risk is up. Risk-free rate of return is up, which means it's even more dangerous now to buy this market. It seems like such an odd point to make, right? Because, so Jeff, explain this to me again. Let's try to explain it again. So, hi, my name is Jeffrey Cohen, Chicago Quantum. Nice to meet you. It's Friday, July 8th, and we're going to talk about risk and return in the stock market. So, you ever heard the story where people say, without risk, there's no return? Or they say, you have to take a risk to make money. Or come on, go for it, right? No guts, no glory, right? So let's talk about no guts, no glory. Normally that meant grabbing your troops and running into danger. So what it means in the stock market is that when stocks don't move, when they're flat, and maybe they pay a nice dividend, you don't expect a lot of return. Prices go up when stocks are smooth. In fact, I can show you this in a chart, but I just want you to understand the concept of it. When prices rise in a smooth manner, look how smooth that is. We're talking like baby's bottom smooth, right? From here to here. Just went up. Smooth. And it's okay, it makes sense, because there's no risk. You're not worried you're going to wake up in the morning and the market's down 20%. You're thinking everything's going to be okay. Let's say you bought the top. Let's say you were a stupid asshole and you bought the top of the market. You didn't do badly. You're in a nice... Okay, let's say you bought here at the worst time of the market. You still went up nice and smooth. Let's say you bought here. Nice and smooth. Everything's smooth and high and going up. And that's great, okay? That's really great. That's what you want. That is the the prize, right? But now let's take a look at the market in a different way. Let's look at it when it starts to go down. And you see how wide these trend lines can be. These trend lines are crazy. I'm going to cross a trend line here just to show you. There's like some wide stuff going on. It's crazy talk. Okay? This is not okay. It's first off, it's declining, but it's wide. There's no little channel. What you want is a nice little channel. So let's say you bought here at a relatively high number or whatever here. It's a wide channel. It's a lot of risk. And as that risk becomes larger and larger every day, you need more return to hold the stock market. It should start kicking in now. I'm not going to buy stocks with the next dollar that I earn unless the price goes down, because I have to make more return. I could buy I bonds. If you're a small investor with $10,000 or less to invest, go buy a savings bond. You earn almost 10%. This is a crazy market. 10%, done. CHF, buy 10%, $10,000. That's all I got to invest anyway, right? I'm home from college, right? I need $1,000 in a year to pay for tuition. Great. You got it, buddy. Buy a savings bond, no risk. Versus this is very risky. It's a very risky market. And so the prices of stocks must go down in order to justify new investors to hold the risk, because the variance keeps going up, which we keep publishing on our website. We're telling you that the risk is going up, not in an aggressive way, but just with facts, right? The S&P 500 index in May 17th had a variance of 1.2 times 10 to the negative 4. So 1.2. Now it's 1.6. That's a lot more. That's 33% higher in a month and a half. We look at risky crap stocks, 4.2 come to 4.9. That's 20% more risk. Now, they were risky anyway because they're money-losing risky stocks, right? We take a look at really good stocks, safe, profitable stocks, right? Lots of them, 2,000 plus. Went from 1.4 to 1.9. It gives me the chills. It's up a third. The risk of profitable stocks is up a third. So you better compensate me as an investor for holding that risk. And this is what's important. So this is why people are shorting the market. This is why people think it's a bear market. This is why I hear people say, oh, when we hit rock bottom, and when the market finally bottoms, it's going to be flat. It's going to be flat. It's not moving. It's flat. Well, the reason they say that is because the variance finally starts to come down. There's a consolidation pattern that we see in certain stocks. Let's see if it shows up. Simple consolidation pattern. Let's look at Apple. Let's see if Apple is ready to rise, right? So what you want to see is a period of flatness. I don't see flatness since here, maybe 2020, January. See a little bit of flatness here. Now, these are flatnesses that actually consolidated because it didn't go up anymore, and so it dropped, which is interesting. That flatness is because it dropped. It was not a bull flag, it was a bear flag. Bear flag, technical term. Do a quick Google search, understand it. Is there another stock that might be bottoming? Let's look at Microsoft. No. Microsoft climbed. flat here at the top and then dropped. And here's the thing. We could be in a Microsoft situation. I'm going to doodle for you here. We could be in a Microsoft situation like here when it dropped. Right, this whole thing could be that kind of a drop. Or you're in a big decline. Hard to know. It's hard to complain now if you're like, oh, I'm losing my shirt on Microsoft. Because if you held Microsoft from the beginning, you bought it at $25 a share, and you sold it at $350 a share, or $300 a share, or right now you sell it at $270. You made 10 times your money. Microsoft was an excellent investment to hold. So, but where do I see it? So there's a stock that we don't talk about much, SMLP, that I want to buy. If I had money, I'd buy it. No, I don't have any money. I'm broke. Broke. I ain't saying she's a gold digger. But she ain't messing with no broke. So this stock moved, went crazy. And with the exception of some nice moves, those are some nice moves. But you see periods of calm. Periods of relative calm, right? And so it's trying to find its way. That's a good sign. Relative calm is a good sign. So I guess what I'm telling you is when the market gets risky, gets frothy, moves a lot, it's bad. It's bad for you. It's bad for you to spend your next dollar in the market. It's time to get out. Not that you have to sell what you already have, but let me just show you a little thought experiment here. By the way, if anyone's out there, I see some people. You could chat to ask me anything. I promise I will try to respond to whatever you chat. I'm on a high horse here. I mean, hopefully you don't mind. This is some heavy stuff I'm talking about. Really heavy. So this is the S&P 500. S&P 500 for one day. And you look, and there's some red, like American Mobile. Isn't that the cell phone company of Mexico, I think? Colgate-Palmolive down, British Tobacco, but in general, everything looks pretty green, right? So let's look for a week. And suddenly you see over the past week, oil's down, basic materials down, gold's down, and some financials are down. Berkshire Hathaway looks great, up 2.2% for the week. Now we look for the month. In the month, it's blood red, but healthcare looks good. And some consumer defensives. Look over 3 months. Healthcare still looks good. But the rest of the market's red. Tech is down. Financials are down. Comms are down. Go 6 months. Energy's up. Healthcare's up. We go a year. Energy's up a lot. Utilities look good. Insurance. So the point is, it's a lot of movement, right? A lot of movement. And so if we were to look at bubbles, and we were to look at all the stocks, you would see that for the most part, stocks are up. And the big stocks are really straddling that 0% return. I find this very interesting. The y-axis should be market cap. You see big stocks that have drawn a lot of money. Okay? There are some really big stocks that have elevated up. And the challenge that you have there then is that money is going into just a few companies. So that also potentially adds to the risk of the market. So we're going to take a quick look at, first off, we'll look at our holdings. Pre-market, nothing's really trading. With the exception of Corbis, CRBP, which looks rock solid these days. Corbis. Who knew? Who knew? Corbis looks good. And I think I know why Corbis looks good. By the way, Corbis never looks good. But DM me or hit me up on Twitter or give me a phone call and we'll talk about Corbis. I put in the walking wounded. These are the stocks that are really in trouble, right? They have not been performing well. And you can see here, mostly red. I got to make sure my daughter gets up for camp. 7:30. Right. Some stocks are up this morning, pre-market. There's more bets right now. So ATI Physical Therapy is up almost 5% pre-market. AutoWeb, Rewalk, Foot Locker. But you got a lot down. I've been hearing a lot about Warner Brothers Discovery, WBD. I hear there's some big money going into Warner Brothers Discovery, just FYI. Regional banks. How are we doing on regional banks? We recently took out our foreign banks in this one. So you got a couple that are down pretty significantly. And you got a couple that are up, not that significantly, but a little bit. Most banks are in the middle. They haven't traded, or they're at zero change. Money managers. Pre-market. You got about 8 of them down, and you got about 10 of them up. Okay, so it's balanced. That tells me maybe the market's not going to do so bad today. Oh, pre-market. Crypto and physical mining down in the dumps. That tells me there's recession fears. Cannabis, tobacco. Mostly down, right? Disposable income, mostly down. Chips and semiconductors. So here's the thing. So normally on a down day, they're all down. People are picking winners here. There is some selectivity going on. Currently efficient portfolio. These were the picks like a day or two ago. Set to open lower. So this would tell me that as of this moment, the stock market will be red, bear, red. It's going to be a tough Friday. I don't know for sure, but it looks like it's a tough Friday, but not a disgusting Friday where everything crashes. Just economically sensitive stocks, retail, and some furniture. You see a lot of red today. A little bit of green. Levi Strauss is up 5%. Dollar General. People shopping at the Dollar Trees. Let's see Dollar Tree in there. Nope. So, get some. It's not so bad. But a lot of negative too. So, it's probably going to be a down morning at least. So, we'll do a quick scan through the other data. This was interesting. Tesla sells record number of vehicles that are made in China. And it's easy because it costs less to make something in China. And if Tesla can make its electric vehicles in China, then really you can make anything in China. U.S. labor, June non-farm payrolls are up 372,000. The consensus was up 250. Unemployment rate looks like it's unchanged at 3.6%. So we had a strong growth in the labor market. Strong growth. That's good. So solid jobs. It's probably going to be good for the stock market. If we look over the day, we look over 5 days. Let's get the VIX out of there. It confuses people. So, confuses me. Over 5 days, the market looks like it bounced up, and then broke through. It broke through on the 5th into the 6th and 7th. So the market is doing okay. The market is trying its best to recover from June 9th when it started to fall through. So, could be that the market doesn't want to take the loss. Advancers, decliners. So yesterday, corporate bonds, more decliners than advancers. Treasuries, a lot of volume, nothing really moved. But corporates, that's a big deal, right? So And the blue is investment grade. So more decliners than advancers. On the high yield, more advancers than decliners. People ran towards risk yesterday. Roughly a 19-to-1 new low, new high ratio for corporate bonds. There was a lot of stuff there. I just wasn't going to go into it. It's too much detail. New lows to new highs is 3-to-1 yesterday in the equities market. And you can see the market went up and it just was a steady climb higher. It's interesting. It was a good market yesterday, equities. People made money yesterday. Crude oil, 102. These are the current futures. Thank you, FinViz, for the visualization. We really like it. Gasoline, $3.38 a gallon. Wholesale, I got to buy 42,000 gallons at a time to get that price. Bonds are up, which means yields are down, which means most likely stocks could go up. The euro looks like it's solidified. Euro dollar, 102.1. It's interesting. NASDAQ is down. S&P is down slightly. The Russell's up. So I think maybe people are going to start picking winners and losers. Bitcoin at 21.4. That's up, actually. Don't believe the hype that it's red. That's up above support at 20,000. So Bitcoin's looking good right now. We look at the news. Yeah, the first thing was the assassination. Yeah, we're not talking about that. That's weird stuff. Oh, this was something important. COVID. COVID's still here. COVID's rising. More than 5,000. I haven't seen that in a while. You have 5,100 new hospitalizations with COVID. Even though the number of cases is flatlining at around 106,500 7-day moving average. Although the new cases hit 141,000 for the day. So post July 4th, hospitalizations are up. And so I want to talk about that for a minute because it looks like COVID's not going away. I don't know if these are new hospitalizations for new patients or hospitalizations for patients that have gotten COVID again and again. But it's not going away. Now, we're not at 20,000 where we were at the peak. We're not at 15, but we're 5 and we're growing. We're rising up. So 10-year Treasury, actually the yields popped up, which means the bond value will go down, which means people are not running to safety treasuries and the interest rates will go up. 1.5% on the 1-month treasuries, 3.23% on the bonds. So maybe the news story for today is because you were patient and you stayed listening. This morning, 10-year and 30-year US Treasuries are trading lower with higher yields. And when we look at that, here's what we think. We think that as interest rates go up and the price of bonds goes down, that the bonds get cheaper, which means expected returns will climb in the future. Are climbing. Expected returns are climbing for the next dollar invested. That's interesting for us. We think for stocks, there's more falling to do to account for higher risk-free rates of return. Note the treasuries and higher variance of stocks, even good ones. So when we look, we're not surprised, right? Why do interest rates go up? They don't go up because Uncle Sam, because Uncle Chair Powell decides it. They go up because people don't want to hold the bonds. because they're afraid. They're afraid to hold that paper because the price is going to go down. Why is the price going to go down? Well, there's a lot of inflation and there's a lot of jobs, which means more inflation. There's good economic data. Where's the mortgage rates, right? My guess is you're going to see something about mortgage rates. It's going to be interesting. Mortgage-backed securities. Let's look at our MBS dashboard. I probably have to move this into the morning look. I think it's important enough. So your fixed rate mortgage is 5.73%. That went up. 30-year fixed rate mortgage. That's interesting. And if we look, your mortgage-backed securities, let's say moderately weaker, but actually it looks like they just strengthened. No, it's down. Moderately weaker is fine. So yeah, weakening slightly, about 100. 100.19. And if we look over the month, you see they've really moved. They fell to a low of 98. And now they're right around 100.2. So there's still 2% more to fall to hit the lower point where it was before. 98 gets pretty low for mortgage-backed securities. And we can look at the Ginnies. They have a good decline there. UMBS, they have a healthy decline. We look at the 30-year treasuries. You see the rates are going up. 10 years. And so it's interesting because here it says 2.978. That must be 2.98. 10-year treasury. Yeah, 3.08. And so they just popped up this morning. That's a big pop. Rates go up. Bonds go down. Companies that hold bonds on their balance sheets suffer. Interest rates go up. Mortgage-backed securities go down. Slightly, but they go down. And that's bad for companies that hold mortgage-backed securities on their balance sheets. It's also bad for consumers because consumers that need to buy a home have a higher fixed rate mortgage. So let's say you entered into a mortgage or you really can't afford it. The house is too expensive and you're struggling and you want to refinance. Right now you got to refinance into almost a 6% fixed rate mortgage. You're probably paying points. And it's hurting you in fees. So, yeah. We're in a bear market. Don't forget it. You are in a bear market. Now, the S&P 500 is like the best risk market that you could invest in. When we put the S&P 500 or the TNA, which is the triple S&P 500, it's a great risk return. It is great. Look at it. I'm going to curve that up a little bit just to make the point here. Now we look at it on the downside, and I don't think this is the curve. I think this is the curve. I'm going to go even better for you. I think. I just don't want to be overly dramatic with charts. That's a problem I've seen people have. They just get dramatic, right? Oh, it's terrible. You're not going to make it. There's your trend line. Trend line goes to 3250. It calls for some downward movement. And so I want to thank you for listening. We're going to do a quick check of our holdings. By the way, this was really cool. I feel like I understand now why the market's going down. And it has nothing to do with politics. It has everything to do with risk. Risk and risk-free rate of return. So our holdings are down slightly this morning. Your current efficient portfolio that we picked a couple days ago, for the most part, it's down. This is not a good day in the market. Money managers, pre-market, still confident that they're going to do fine. So maybe it's fine. Maybe everything's just going to be okay. It's just going to be a slight decline today. But some of your risky stocks like Party City are down. But ATI Physical Therapy is up. That's a bet on the economy and on jobs. People that have good jobs have workman's comp. When they have workman's comp, they have an injury. They go to ATI Physical Therapy, get their hand fixed, their arm, their shoulder, injuries. ATI Physical Therapy does well. And so it could be that ATI Physical Therapy is a way to bet on the end of the recession. That would be my bet. Lower inflation, lower wage inflation, and higher employment means ATI Physical Therapy goes up. So thanks for listening. If you like the stream, hit the subscribe button. It's a red button. It really helps us. It helps YouTube to share the message. We don't advertise the videos. We don't get paid to make the videos. None of this is a money aspect. We do it because it sharpens our needle or our pencil to look at the markets. And it gets you engaged. Hopefully you reach out. Maybe give me a call. Good, you're alive. Thank you, Gregory. Thank you, yes. We missed the Highland Park, Illinois parade by about 30 minutes. We just didn't feel it. So we survived. Thank you, by the way. And, yeah, good luck out there. I'm going to share with you our bets. What are we doing? Just so you know. Gregory, this one's for you. We have puts on two banks that are holding an enormous number of long-duration bonds and mortgage-backed securities. So many, in fact, and they keep buying more, but so many, in fact, that if they just keep declining the way they're going, these banks will have no capital left. And they will either have to have a big sale and have lots of new depositors, or sell bonds, or go bankrupt. So I'm betting against those. And I'm betting on a fast move because I don't think bonds are done yet. We're also long Corbis and American Shared Hospital Services because those stocks have amazing valuations and they are the key to value being unlocked over time. So Corbis is easily a $1 stock. It trades at 30 cents. American Shared Hospital is easily a $3 stock. It trades for $2.27. There's money to be made there. I don't know how far or fast the banks are going to fall, these two particular banks, Bank of Hawaii and Lakeland Financial Corp., but they are overpriced stocks. And we're not the only ones betting against them. And every time that I see interest rates climb, look at that climb on the 10-year. Look at the climb on the 10-year. Look at the climb on the 30-year. I'm putting it out over a month just so you get a feel. Now over a month, it's not that high, the 30-year. Right? 10 years. No, it really isn't. I mean, there's plenty of room here. You're reverting to the mean. And on mortgage-backed securities, we go for a month. You see those declining trends. Yeah, I think it's a safe bet. So, good luck today in the market. Be safe. It's Friday. It's July 8th. I don't know, man. I would not be in this market. Look at that. Straight up on the S&P 500. And whether you believe this little line or not, it's fine. It's straight down. So you're betting against the trend. They say the trend is your friend. So good luck today. You take care now. Bye-bye.